now let's take things a step further. While private markets offer great opportunities, there is an even bigger world of growth awaiting to be explored: SME IPOs. We are fortunate to have with us today Mr. Soumya Kanta Padhi, the Managing Director and CEO of Indorient, who will be sharing his expertise on beyond private markets, SME IPOs for startup success. Let's welcome Mr. Soumya Kanta Padhi to the stage. Sir, please.
Uh, what I typically say is bulk of the companies which are there in the startup ecosystem and at the budding stage will be looking at support from the VCs of the world and angels of the world. That is, as I typically say, you are at class 1 to class 10. So as you go from the school to the college, you will need higher support. You have studied, you have gone through the syllabus, you have 90% marks secured, and now getting into the college, it is a different atmosphere altogether. The teachers are different, expectations are different, and your competition is also different. So let's start this little kind of introduction and on SME IPOs. Personally, I'm a chartered accountant of 20 odd years of experience. I'm a MBA from IIM Calcutta. I call myself a exchange specialist. The reason being, I worked in all exchanges, NSE, BSE, MCX, in top management. And like quite a few in the startup ecosystem also, after having worked for a couple of decades, professionals get bored of doing 9 to 5 jobs and they try to decide to do something different. So I am one of those kind where the bug actually caught me. So I left my job in 2018 and started this setup. We are SEBI registered merchant bankers and primarily we support companies to do fundraise, not limited to SME, but we do startup fundraise also. Or rather, I would say, put it, I support companies across the entire rainbow, from startups to mid-size to SME, all the way to the companies which are not doing well also. We call it sick companies or stress assets. We do support everybody. Now let's talk about the SME markets. You must be reading in the newspaper. SME markets are really the what you call the next things which are happening as far as the fundraise is concerned. It's highly structured, highly regulated. A lot of people are actually scared that, okay, how do I do the regulation? How do I manage it? But yes, there are specialized people in the market who support that. And it's that you have to make up your mind that, yes, I'm ready to go public. All I normally would like to say that is money doesn't have any color. Whether you take it from the bank, whether you take it from a VC or angel, or you take it from public, it's the same greenback. Now, of course, the notes have different colors today, but it considers the bank where the money ultimately stays, the digital side, there is no color. The methodology of getting the money and the process of getting that money changes from different sources. From bank it is different, from VC it is different, from public is different, but the fundamental remains same. What are the fundamentals? Why you need money? What are you going to do with the money? How do you intend to, here there is no return, how do you intend to grow the business? In both other places, whether VC or banks, they will ask, how do you intend to return the money? Or how do you intend to give me an exit? Public markets, there is no demand for giving exit to the investors. That is why it is regulated, it is structured. It takes slightly longer time compared to a normal VC or an angel or a bank deal. Now these are something we do, let's skip this. These are basic introductions. Okay. These are some of the industries we deal with as far as fundraise is concerned. And you can relate yourself into one of these industries, and we are fully aware of the industry as far as the public market part is concerned. These are some of the companies we have already listed. If you look at it, all of you might be using digital signatures. Right on the left side corner, they are the biggest digital signature company in the country. Almost $1 billion valuation as of today. And it's a main board transaction, not an SME transaction. We assisted them by raising 450 crores for them from the public markets. They started at a issue price of 256. I think today it's at 900 and or. Listed in 1st of June 2022. Now, what kind of numbers they were commanding at that point of time? They had a 38% EBITDA, 22% PAT, technology company. So that kind of showcases the kind of margins you guys typically enjoy if you are technology driven. Your costs are not broadly manufacturing costs or asset heavy. Your cost is manpower cost. Your cost is your technology cost or the licensing cost which you take. Similarly, the next one again is a unique company. If you are eating pizza, they are the major suppliers of cooked chicken for Domino's across India. The Jubilant Foods, which is listed, they are the prime customer. And then Coffee Cafe Day, you have Burger King, you have KFC, all of them take their chicken from them, which are processed. Canaries, again, a Bangalore-based IT company. They are into IT solution implementation. They are Microsoft Gold partners. They implement IoTs, they implement water resource management solutions for World Bank, ADB, and IFC. Plada is a manpower services company. They manage credit card services processing for Amex and a couple of more banks. Technogreen is a ESG consulting company. Everybody's talking about environment and similar kind of areas. So they consult, they provide the solution to large companies who are implementing their projects for environmental clearance and those kind of supports. New Jesa, again in Bangalore, they refurbish laptops and sell it on Amazon, sell it on Flipkart, sell it on all type of online platforms. Last one, they are again a large consulting firm. They are almost the largest consulting firm in the country who provide support for compliance and back office to brokers, stock brokers. As I speak, I have filed one more company from Bangalore which is into hotel management. They manage almost 500 keys. I have filed one company from Baroda which is into manufacture of transformer spare parts or the core of the transformer. One company filed which manufactures lithium batteries. And the fourth one, which most of you will be looking at, is a headhunter. Headhunters going to public is unheard of. Recruitment agency going to public and listing themselves is unheard of. That might be the first of its kind. We will be raising close to 100 crores for them. Now, what are they going to do with this money? That's the obvious question. Now, this is the pipeline. As I was talking about, the 4 which are filed already. This side are the mainline companies which are in process. Now, what are these mainline? What is the kind of flavor of the market today? Is the power, food, infra, health. Broadly, these are the 4 areas which are becoming the flavor of the market today. Biggest of the companies are coming in this side. And those who do not fall into those brackets, even if they are coming with the biggest of the IPOs like Hyundai, the prices crash dive because there are no supporters for them. So demand is there, money is available to be taken. How do I take it is the question. Lot of words which are given in the presentation, which you can take it from the team at a later point. are technical. I don't want to explain you in detail, that will take days to go into that. Now this is a broader process of documentation. Again, to decide, if you do a plain simple reading, the 3 questions which I asked, you have to answer yourself first. Why do I need the money? How much money I need, and what I'm going to do with this money? When you go to public, there are a lot of disclosures which have to be done. Lot of compliance requirements are done. Typical time process, 6 to 9 months. Even after getting the money, unlike the other two, you are accountable for every penny you are spending. Your chartered accountant, who is your auditor, or you have to appoint a monitoring agency, who is going to monitor how you are spending the money which you have taken from the public. Because this is not private money. This is public money. So you are accountable to the investors who have given you money. However, typically we say that, okay, if you go to public, you may have to dilute slightly higher compared to a private deal. Maybe you dilute 10%, 15% to start with. Here, you may have to go at least a 25% minimum. Now, you will say, okay, I will take the money, I will buy a car, I will buy a house, I will do foreign trips, I will spend on luxury goods. Nobody is there to question me. Money is in my account only. But you have to report that in your balance sheet, in your profit and loss, in a quarterly or 6 monthly basis to the public. For those time period, there will be no questions asked. The moment you report this, the investors are going to start questioning as to why you did not stick to your disclosures when you actually took the approval for doing the IPO from the regulator. Now you are holding 70% or 75% of your ownership with you. Public is holding only 25%. But the value of your 75% will be driven by the price of the market or share price which is there in the market. And the investors don't like you. They will drive down that price like anything. And your value of the company will, along with that, will go down. And somebody said that, okay, money raising process is a continuous process. It never stops. Same goes for public market also. The way you grow, you will need more money. You have to again go back to the market. If you have ethically utilized this money properly, the way you have given a declaration in the document before the approval has been taken, then the investors will remember you that here is a promoter who has stuck to his word and has invested properly, has not misutilized the money. All of them will be in the queue, standing, requesting you, tell us when you need more money. Imagine a situation like this, you as a promoter, that you have unending supply of money. Imagine the comfort. You can do whatever you want. And for a promoter who is into business, the biggest problem always is the cash, the liquidity. If your liquidity problem is taken care of by your investors, you can go, and as you call it, sky is the limit. That's what the public market offers. These are the preparations. You can do a plain simple. Let me move ahead. Now, let's talk about some timelines here. What kind of timelines we are talking about? Just read through. Is it visible? You can see to the last. Slightly hazy? Okay, let me read it out to you. Okay, today you start, for example. We take between 3 to 4 months to prepare the document which we called as a draft red herring prospectus, which is an official document which is filed with the regulator for approval. Now, what does it contain? It's a 500-page document. Big document, but majority of them, as somebody said, is taken care of by the lawyer. So the lawyer plays a very important role here. Your information, whatever you provide from your company's side, along with the objects of utilization of the money, has to be captured in this document and filed with the exchange and the ultimate regulator SEBI for approval. Once the approval comes in, the next 2 to 3 weeks, maximum 4 weeks time is what we get to meet the investors. Who are the investors in IPOs? You have funds, you have mutual funds, you have HNIs, and you have individuals. Now, why should somebody invest in your company? An analyst has to write on your company as to, okay, this is good. And that has to be published in media like CNBC, like Z Business, like a lot of websites are there. And you need to be the public face. You should give interviews to this analyst so that the investor community knows about you. You should publish your advertisement in newspapers. And it's a proper process which goes into it. And it's serious business. Whatever you disclose cannot be futuristic. Unlike a VC deal where you talk about 5-year ahead numbers, you do the discounting. Public market doesn't allow you to disclose anything futuristic. It has to be all past numbers which are audited. Officially, you cannot disclose this. It is a violation of the rules. So how do you tell the investor, okay, what I am intend to do, how it is going to grow? It will be in the closed door. It's not official. The investors will definitely ask you, okay, you are taking 100 crores from me. What are you going to do with that? Apart from whatever writing you have given to the regulator, you have to convince them, oh, yes, this is how I intend to use the money. I am not using the money to repay my own loan. I am not using the money to repay the bank loan. Bank loan is cheaper than the equity. I am not using money to buy land. Those are things which are unproductive as far as the business is concerned. Best few things which we typically advise is you are doing capital expenditure to expand your business. You are looking to acquire more companies. Yes, definitely yes, because you are doing an inorganic growth there. You are trying to do manpower hiring. Yes, like for example, in headhunter company, the only asset you have is manpower. You want to expand offices. You want to go to new geographies. All of them are acceptable. Now, there is a interesting element in this part. SME part, the capital which you typically raise from market is called growth capital. Some of the promoters might say, I have been working for last 20 years. Now, this is an opportunity. Can I take some money home doing a secondary sale? As of today, we are doing it. A small person, maybe 5-10% of 100 crores you can take home by doing a secondary sale from the promoter. So you take home as a promoter maybe 5-10 crores. But the latest regulation which has come in from SEBI, if that is implemented, that also will not be allowed. Okay. Now what is the structure in broad sense? Suppose 100 crores you are raising from the market. 25% of that 100 crores is given to you as something called general corporate purposes. So no questions are asked. You can spend the way you want it. 75% you are answerable to the regulator and public. So if you want to do a capital expenditure, you want to buy a plant, you want to buy a machinery, you want to set up a building, you need to provide documents supporting the pricing of the plant, pricing of the building. You have to get a certificate from a chartered engineer along with a detailed project report lining out detailed cost of the entire project and file it for the approval. It is that detailed. And post getting the money, the monitoring agency is going to come back and ask you, show us the proof that whatever declaration you had given, you have stuck to that. And this report goes to the regulator as a proof of utilization. Now, these are some of the, again, detailing and corporate governance, which I can give you some as a overall kind of thing. Now, what is corporate governance? Corporate governance requirements for the IPO. We call it 3 C's. 1, you need to have a CEO. You need to have a CFO. You need to have a company secretary. All of them in the roles of the company, not some outside agency supporting you. Full-time employees. Mandatory requirement before you file the IPO. Now, for example, you are already a size of 250, 200 crores size. you are still using Tally as a software for accounting. Not appreciated. Reason being, the data security is very, very critical. Anybody can go into Tally and change the numbers. Even if you don't take SAP as a ERP, take a generic ERP and implement it so that the data security can be very well checked and the data trail and the information trail can be audited by a proper auditor. One of the requirement is that your statutory auditor should be peer reviewed according to the Institute of Chartered Accountants of India. Whether that firm has a capability to manage your IPO process, you need to check that, or we replace the auditor. I'm not scaring you by telling you all this. But when you have reached a level of 100 crores, you should be looking at the next jump rather than trying to tell that, okay, why should I pay tax? Your statutory auditor who is planning your tax and me as a merchant banker, we will be sitting at the opposite side of the table. I'll tell you why. Unlike the valuation process of your VC, where the DCF is the method, or it's a bilateral process, the process which is followed in an IPO is more to do with your past records and past profits, which are filed and officially audited as a starting point. We do take a little bit of forward numbers, but that is very small. For SME kind of thing, we may take a 6 monthly kind of forward numbers. On a main board, which is 150 to 200 crores, we may take a 1 year forward numbers. But that is again unofficial. That cannot be disclosed in public. So when we file for the document, it is always the last audited numbers which is available. So the valuation metrics are totally different. Here the metrics are how much profit after tax you have shown. As a practice, nobody shows tax after profit. Why should I pay tax? That's the standard question. Now, why should I pay tax? Here the multiples are based on the profit after tax. Higher the profit after tax, bigger is your valuation. So what do I do now? I have not been showing profit for so long. What do I do now? Standard advice. Start your process or cleaning of the process or cleaning of your document, cleaning of your account today itself. If you need money today and if your bankers are willing to give you money, take money now. Term loans, take. Start the process of the IPO today. Now, as a standard process, any merchant banker who will sign a mandate with you, tell them that if you are signing a mandate, you have to ensure that I get the money, whether it's 18 months down the line or 2 years down the line, money has to come. Because one of the utilization of that money is you are going to repay the loan which you have taken today. That is allowed because that's a term loan, not a working capital. And term loan you have taken for a setting up of a specific project. You can pay it back. You are allowed. So this is one way of doing it. It is a journey. That's what I said. It will take longer time for you to reach there compared to all other sources. But unlike other places, this is a marriage. All other places, there is a provision for divorce. There is no provision for divorce here. Exceptions are allowed in courts, but broadly, people don't list their company saying that, okay, today I list, tomorrow I delist. Doesn't work. And primarily, people want to list because you will have a continuous availability of public capital. These are again the definite processes, as I mentioned about it. Let's move ahead. Look, these are the intermediaries which you need to appoint. Some of them you might have heard, some of them you have not heard. Starting with a merchant banker, there is legal, there is register and transfer agents who will maintain or manage your shares. Yes, there are a few things which you should do whether you are going ahead with the IPO or not, doesn't matter. The three things I said, appoint your CEO, appoint your CFO, appoint a company secretary, demat your shares. Do not keep it in physical form, because that is the easiest way of storing it, easiest way of transferring it. Side by side, as I said, the accounting process, accounting software need to change. Ensure that all your regulatory filings, Companies Act filings, or any licenses which you are under working, or to the extent the Microsoft license which you are using in your laptop should be official, not some cracked version which you are using. That's a huge red flag for us. Ensure that you do not have any disputes in your name or any legal things which have been filed against you. Bring it to the conclusion, or at least ensure those are taken care of. Do not create unnecessary dispute with others, because those things will also get disclosed in the public as a part of the risk factors. So don't do anything which is going to come back to haunt you in future. Today you might think, okay, this is the right thing to do. It might come back and haunt you in the future. Don't do that. So these are few of the roadmaps as a starting point, as a back of the hand advice which I would like to give you. Now, can somebody tell me, in a PE deal, how does the process of transfer of the shares and the transfer of money takes place? Is that they transfer you the money and then you transfer the shares? Or there is a concept of escrow account? In IPO, escrow account is a mandatory requirement. All money gets deposited in the escrow account. There are 3 signatories: merchant banker, the register and transfer agent, and the company. Unless 3 of the parties sign, money will not get transferred. So, money has to come to the register and transfer agent like Carby or Big Bear or LinkedIn Time. They will assure that yes, everything is there, the shares are there. They will allocate the shares from their system. They will confirm that money has come. They will report to the exchange and the regulator, everything is taken care of properly. Then I will sign, they will sign, and the company guys will sign. Then only the money gets transferred. If one of the parties say no, there is something wrong, money stays in the escrow account. Post you getting the money, there is a provision to appoint credit rating agencies, ICRA, CRISIL, CARE. They will monitor how you are utilizing the money, and they will report to the exchange every quarter or every 6 months based on the requirement. Now, there is one more requirement. You don't start the company as a one person. You start with 2 or 3 people together. And if you are converting that into a company, you say, I am the director of the company. As a requirement, you need to have executive directors, you need to have non-executive directors, or independent directors as we call it. IPO requirement is, if you have 2 directors in your company, 2 of you are directors, you need to find out 2 directors who are not related to the company, appoint them as independent directors. And one of them, the 4, has to be a lady. So every listed company is a mandatory requirement today. One director has to be a lady. Whether it is 4 or 6 doesn't matter. Now why 4 and 6? Because the executive directors and the independent directors number has to be same. The independent directors are coming in to protect the public money interest, because you are taking money from public. So any decision which you take in the board of directors meeting, the owners directors cannot overrule the independent directors if there is a issue which is under dispute. 3-3, 2-2. Lady director can be an independent director. She can be an executive director also. Doesn't matter. And you have quite a few committees which are required. Audit committee, compensation committee, the women, that protection committee, that is, what is that? For the sexual harassment, yes. And of course, we have been talking about ESOPs. Now, why should you give ESOPs? As a standard market practice, if you are a progressive company, you would like to retain talent in the company and also attract talent into the company. One way of reducing your cash outflows is giving ESOPs. However, if you are a promoter, there is a warning that the ESOP pool is basically going from your own pocket. It doesn't go from the company or anybody else. You have to take out 5% as a market practice, keep it aside, and call it as a ESOP pool, which has to be demarcated and reported under the SEBI Act. There is a dedicated regulation for that. Whether you give it to anybody doesn't matter, but you cannot utilize this for any other purpose. And then that policy of ESOP has to get married with the HR policy, that how you intend to give those ESOP shares to your existing employees and to the new employees which are coming. There is a question whether the management can get ESOPs. No, they cannot. You are already a owner. You have given your own shares out to give it to your employees. Look at the nomenclature. Read. ESOP, employee stock options. You are not an employee of your own company. You are an owner. You might be drawing salary. That's a director remuneration. So you need to be an employee. You need to prove that you are an employee, then only you can get an ESOP. That is why the promoter directors are not allowed to take ESOPs as a regulation. Now, coming back to the utilization of the money again. You will say, okay, I would like to acquire company. If you want to acquire company and this goes as part of the declaration in the document, then you should have already had the term sheet in hand. Signed the term sheet. So when the money comes in, you just have to pay them and take over the company. To that extent, you should complete your work. Now, obvious question, everything is done. Documentation done, compliance done, appointments done, entire process is done, approval done. What is the guarantee that the IPO will go through? Not many people know that SEBI has a regulation that SME IPOs are 100% hard underwritten by the merchant banker. If public do not put money into your IPOs, if the IPO issue is open, any shortages has to be fulfilled by the merchant banker from its own pocket. That's the insurance which you enjoy. And that is specifically limited to only SME IPOs. Now, what is the size we will be looking at? Now, size is a subject matter. But typically we will say anything above 20 crores all the way to 100 crores of fundraise from the market, you can go to the SME market. What is the structure of an IPO? There is a concept called book building. If you are raising 100 crores, 35% is reserved for retail, 15% reserved for HNI, and 50% is reserved for qualified institutional buyers, who are called QIBs. Now, who are QIBs? They are SEBI registered funds, mutual funds, or alternative investment funds. Majority of your VCs and angels are category 1 alternative investment funds. Some of them are category 2, and category 3 is primarily into listed space and they trade. Some of them, at least in Cat 2 and Cat 1, they also act as debt funds also. They become venture debt funds. But most of the companies which are angel are category 1. So all of them qualified to participate in the QIB. This is the structure. If retail doesn't come, they don't believe in your story, whatever is left in retail can be absorbed by the QIB. Spillover, they can take over. So ideally, it is better that the funds come into your company because they stay. It's not a question of loyalty, because they have a setup, they have a process to evaluate your company, and they put bulk money. The typical ticket size starts at 1 crore or a couple of crores for fund minimum, as far as IPO is concerned. So significantly bigger numbers they commit. So they go through the entire process of doing the analysis, doing the diligence, financial diligence, secretarial diligence, legal diligence, everything they do. And before they put the money. And these are the guys will come back to you whenever you decide to take money again. Because if you raise 100, you exhaust that in a year, and you see one more opportunity coming up. Where do you go? You approach them back. If you utilize it properly, they will give you the money at the market rate of your shares, not at the valuation what you have done. And how does it get calculated? It is the higher of last 10 days market price or last 90 days market price from the date of announcement, whichever is higher. Market price, not your books. That is the value which is put for raising the next round. So if your share has gone from 1 rupee to suppose 3 rupees because you have done well, next round of dilution will be valued at 3. So you are 300% up on your valuation. And it is the market who has done it, not you. So your role is primarily to utilize this money which you have got ethically, and the way you have put it in writing in document that this is the way I am using it. There is no other expectation from your side. A lot of people say, boss, what will happen to my share if the prices go down? Are you in the business of share trading? Your core competency is manufacturing tech or services which you have declared, saying that I am good in this. So use your money for that. Do better. Increase your margins, clean up your books, bring more profit to the books. That will help grow your market price and the market capitalization, or market cap as we call it. In normal business channels, they say this is $1 billion market cap, this is $10 billion market cap. That's the value of your company in market. This is a small example of tech companies I thought let me bring in. How do I value your company? You are not known in the market. So I take the value of the listed companies which are similar in space. I figure out what kind of services you are giving, what kind of services they are giving, what kind of financials they have, what kind of financials you have. Suppose they are at 1,000 crores, you are at 100 crores. There is a size gap. So there will be a certain amount of discount which will happen. So there is a scientific way of calculating the value of the company, which is used by all merchant bankers in the market. Now this is serious business. This is serious money because you are accountable to the public now. You will have to meet the investors whenever they demand. You have to disclose your information whenever you decide in a board. Same day it has to go to public. It cannot wait. It has to be online disseminated to the exchange platform. So a lot of regulatory requirements are there, but the better side is the amount of money which will come to you. There is no more bilateral discussions. It will be other way around, that there will be funds who will be chasing you that take my money. Now you are chasing the funds to get the money. The moment you go to public and perform, trust me, I have seen, I'm already 25-year-old in the market. I have seen the biggest of the funds coming and chasing them. Example, you are from here, you are aware of King's Infra. All of you are aware, they process shrimps and seafood. They had come to my office 1.5 years back to raise funds. And they met the Rakesh Jhunjhunwala family office. They liked them. They put the money in them. They are one of the biggest investment companies in the country. So likewise, the market is unforgiving if you do not meet your promises, or at least the utilization part. Now you cannot control everything, but if you are meeting the utilization part, they will take you as ethical. Today, information is available everywhere. You cannot hide. But yes, if you disclose, you are transparent, you are ethical in your usage of money, trust me, money is the least of the worries you will have. But side by side, one more small thing I normally say to everybody, when you grow to a certain level, don't get attached to your business. Don't think this is my baby, I cannot let it go. Once you are in market, there are a host of opportunities which will come, not limited to raising the money. There will be bigger companies which come, they say, okay, I would like to acquire your company. If at that point of time, the value is good, let it go. You will have enough opportunity post that because you will have few hundred crores in your bank account. Then you can decide. Sit down and peacefully decide, okay, what I'm going to do with it. Lot of people I have seen get attached to that. No, I cannot sell. It is my company. I will grow. That's a huge mistake. Unless you are so strong, your backings are so strong that yes, I have the strength to go bigger and become few thousand crores, that's a different thing altogether. This kind of opportunities will come. Once you are in public, you will be known in the market. Multiple bigger companies are looking out to buy out the majority in smaller companies where they like the company performance, they like the quality of the goods. They would like to grow inorganically. So they would like to come and acquire. 51% they will acquire. Let go. These are some of the work we have done anyway. My composition. Anyway. Now, to sum it up, decide, as the typically people say, take the leap of faith. First, decide that I would like to go public. I will not explore the private market. I will go public. I have reached a size, 40, 50, 60, 70 crores I have already reached. Let me explore that. Nobody is forcing you to go public to do this process. Go through that process. As a part of the process, you will clean up quite a few things in your company. You will become more corporate governance wise, you will become more regulated, you will become more clearer in terms of your documentation, in terms of your filings. And side by side, appoint a person who is a good advisor for you. Even I don't know everything. That's why I have a team of people who take care of a lot of this. Legal is separate, compliance is separate. Everybody is a separate team. They are specialized. Nobody claims that you can be master of all. No, we cannot. You are going to get money because you are master of one thing, which is running your business. The person who is putting money, he is believing in you because he knows you are master of that. Hence, you will utilize the money properly and give him the returns. Never think that you will be able to repay back the working capital because you have to pay interest on that. Don't do that. CC limits or working capital limits is the cheapest form of finance. And equity is the most expensive form of finance. If you have had any interaction with any fund, you can simply ask what is the kind of ROI requirement they look for. They are giving equity, right? Starts at 20% and upwards with a buyback clause, with milestone clauses, with tag along, drag along clauses, first right of refusal, NOCs. None of them are applicable as far as public market is concerned. You disclose to your shareholder, this is what I intend to do in your AGM. But all approvals are taken in the board. You don't have to go to shareholder every time. That doesn't prohibit you or discourage you from going to the private market. Lot of companies say that, no, let me reach a certain size, then I'll go to public because my valuations change accordingly. Fine. But plan today. It doesn't happen overnight. Anybody who comes and tells you 4 to 6 months I'll get you the money is lying. It's a good 1 year, 1.5 year process, start to finish if you're starting today. Today, getting a qualified company secretary who has 2 to 3 years experience is tough. Go out and do a little bit of survey for yourself. You will not get it. Find a qualified chartered accountant or somebody who has studied finance to become your CFO is tough. It is not about qualification alone. You have to trust in that guy that he is going to run your entire business as a finance head. Finding independent directors who will have access to every information of your company and also they will contribute to your success of the business is tough. Where you will find? So these are something saying becomes very, yes, I know few people, they will come in and become directors. The moment they become independent director, first of all, they have to qualify under that Institute of Directors requirement. They have to have that certificate. And they are liable for your performance also to the public. How many people are willing to take the liability? And for what? Some sitting fees which you will be paying them. If anything goes with the public money utilization, they will be held up by the regulator. Now, what you are guys going to do? Why you didn't do the blow the whistle when you notice that? You might be coming, simply signing the attendance sheet and taking the check and going home. So those are the issues today as far as this kind of corporate governance and regulatory part is concerned. Money, again I am repeating, is the least of the worries. Humongous amount of capital is standing today to be deployed in the capital market. Humongous. The transaction which I am running, I am looking at raising 100 crores in one and 80 odd crores in one. As of today, I have a standing demand of 500 crores in the 80 crores IPO and 800 crores in that 100 crore IPO. People are willing to put that kind of money. That's the demand. So, because the quality of company and the governance and the promoter are good, hence people are willing to put money. That's your qualification. That's your USP, unique selling point. When you discuss bilaterally with any PE, any VC, what do? You sell yourself, right? That I am good, you invest in me. So they are not only investing into the business, they are investing into you as an individual also. In public market transactions, identical thing happens. You have to meet the, the investors, you have to talk to them and sell your business and yourself. That yes, I am good enough for you guys, put your money. Lot of technicalities are there. Why I wanted to specifically come here and speak, you can spread the word around. You might have friends who are looking to get into public. Encourage them to explore it as a first baby step. Go through the process. I'm happy to come back. I've already told Karthik also, I'm happy to come back and do closed door sessions of promoters who are serious to know even more detail. This is a very granular stuff which I was talking about. So they are fairly aware what they're getting into. There are three distinctly different animals. Banking, VC and P, that is private markets, and public markets. So this is, in nutshell, is all about IPO and public markets. Timelines, 9 months, new baby. Nothing happens. Size, you say 20 crores and above, because that regulation is going to come anytime. They will not allow smaller transactions anymore. See, again, why you want to raise 20 crores? If you want to raise 20 crores, you are diluting 25% at least. You have a valuation of 180 crores, right? To get a valuation of 80 crores, typical multiple what SME market gives is 10 multiple of the profit after tax. That's what it starts. So you need to have a profit after tax of 8 crores. If you have a double digit profitability, you are talking about 80 crores of turn line at least. Simple calculations. That's how it starts. Now 20 crores if you take, is a decent number to take. You can set up a building, you can buy some land, you can expand something, so that's fine. Why not beyond 100 crores? Because again, you are becoming too big. At 100 crores, you are 400 crores size. At 400 crores size, you need to have 30-40 crores of profit after tax. You are becoming big. So that's why the governance or the basic rules of SEBI says if you are going beyond 100-150 crores, come to the main board, where the regulatory requirements are higher, disclosure norms are higher, qualification norms are also higher. The main board requirements, you need to have a 15 crore profitability, operating profit for last 3 years, 25 crores paid up capital. Here there is no such requirement. So you will qualify, by default you will qualify. But primarily remember those 3 things which I said. Decide why you want to go to public. How much money you want to raise from man. Forget about valuation. And what you want to do with that money. If you are clear with these 3, rest are all specialization professionals are there, they will take care of that. Thank you. Thank you so much. Last audited numbers. We use that for filing also. See, your official numbers which are filed with the regulator has to be valid for 6 months. So your March numbers are valid till September. So I have to do the IPO before September 30th. Else, again, I have to move the numbers further. Maybe June numbers I'll have to file when I do the IPO. Broadly, yes. Full. ICDR norms. Entirely applicable. No distinction at all. Qualification norms, eligibility norms are different, but otherwise no difference. Identical. My request again, think about it. Spread the word. Start the process. Like you think, okay, I have an idea, let me explore. This is an idea, explore it. When you are 100% convinced, yes, I am willing to go and do it, then move into hiring some people, move into talking to others, move into talking to merchant bankers. They will start the guidance. For the VCs, tell them they have the exit mode in the SME IPOs only. They have no other way out. Because not every VC has the outstanding record of giving exits or getting exits. They have that 20-30 or 20-80 ratio or maybe 30-70 ratio which still continues. 30% companies will give them good returns or maybe 10-20 times. 70% company will give them 20% returns, not 20 times. So the idea which I am also trying to spread is those 20% companies, bring them to the SME market. The SME market investors are more than happy to get companies which are giving 20% returns. They will put money. They will get their exit, they will get their capital. And the people who are struggling will get into the public market to get additional capital. Because the risk appetite in the SME market and risk appetite on the VC side are totally different. So in SME side, the investors put money into the business, looking at how they will grow in realistic way. Not multiples as we look at in the angels and the PE side of the world. I still don't understand how you guys get so kind of valuations which are, I don't know, they are manufactured or real. But at least on this side of the world, it is all about business. And they will compare with every detailed other company which you are in similar business as you. And they will cross question how you can claim that you are planning to do so much when XYZ is doing this. How you are different. Thank you.
Thank you. Thank you so much, sir, for that wonderful session. So I kindly request Mr. Tom Thomas, the CEO of Kerala Startup Mission, to just give a token of our gratitude and appreciation to Mr. Soumya Kanta Padhi for helping us understand the dynamics of SME IPOs and how startups can leverage this path to accelerate growth and success.